Ever wondered what T-bills are and how they work? Well, you've come to the right place. Today, we're going to unravel the world of Treasury bills, or as they are more commonly known, T-bills. Think of them as IOUs issued by the US government. They're short-term securities maturing in 1 year or less from their issue date. Now, you might be asking why the government would need to borrow money. Well, it's quite simple. Just like how we sometimes need a bit of financial help to pay for things like a house or a car, the government also borrows money to fund its various projects and obligations. And where does this money come from? It comes from investors like you and me who buy these T-bills. So, if you're curious about how these financial instruments can fit into your investment strategy, stick around. There's a lot more to learn about the fascinating world of T-bills. You might be thinking, why are T-bills important? Well, let's dive right into it. Treasury bills or T-bills are not just another financial instrument. They hold a significant place in the global economic landscape. Picture the financial market as a grand orchestra, with different instruments playing their part. In this symphony, T-bills are like the steady, reliable rhythm section that sets the pace for the entire ensemble. One of the primary roles of T-bills is that they serve as a benchmark for short-term interest rates. In simpler terms, they're the yardstick against which other short-term investments are measured. When you hear financial experts talk about risk-free rate of return, they're often referring to the return on T-bills. This is because they're backed by the full faith and credit of the US government, which pretty much guarantees they'll be paid back in full and on time. Now let's consider the individual investor. For them, T-bills offer a low-risk investment option. They're an excellent choice for those who prefer safety over higher returns. Think of them as the tortoise in the race. They may not sprint like the hare, but they steadily make their way to the finish line. Moreover, T-bills play a crucial role in managing the money supply in the economy. The government can sell more T-bills to absorb excess liquidity, or buy them back to inject money into the system. This helps keep the economy stable and inflation in check. Lastly, T-bills are an essential tool for corporations and financial institutions. They offer a safe place to park excess cash for short periods, providing liquidity while earning a modest return. In essence, T-bills are a key component of the financial market. They're the silent, steady workhorses that keep the wheels of the economy turning smoothly. So next time you come across the term T-bills, remember their significance and the vital role they play in our financial system. In essence, T-bills are a key component of the financial market. Now, let's delve into how T-bills actually work. At their core, Treasury bills, or T-bills as they're commonly called, are short-term government securities. They're issued with maturities of 4, 13, 26, or 52 weeks. But what sets T-bills apart from bonds or notes is that they don't pay interest before they mature. Instead, T-bills are sold at a discount from their face value. For instance, you might buy a T-bill for $950, but when it matures, you'll receive the face value, which is $1,000. The difference between the purchase price and the face value is effectively your interest, or in more technical terms, your yield. Now you might be wondering, how do you actually purchase these T-bills? Well, there are two main ways you can do this. The first is through a competitive bidding process, and the second is through non-competitive bidding. In a competitive bid, you specify the discount rate you're willing to accept. However, this comes with a bit of a gamble. If your bid is higher than the rates accepted in the auction, you won't get the T-bill. On the other hand, if your bid is successful, you could secure a higher yield than those who opted for non-competitive bids. Speaking of non-competitive bids, this is the second way to purchase T-bills, and it's a bit simpler. In this case, you agree to accept whatever discount rate is determined at the auction. The advantage here is that you're guaranteed to receive the T-bill, but the yield may be lower than what competitive bidders receive. The bidding for T-bills takes place at auctions conducted by the US Treasury. These auctions occur regularly and are open to both individual investors and institutional investors like banks and financial firms. After the auction, if your bid is successful, the T-bill is deposited into your account, and voila, you're now an investor in US government debt. From this point, you can choose to hold on to the T-bill until it matures, or you can sell it on the secondary market. And one more thing, it's worth noting that the interest earned from T-bills is exempt from state and local income taxes. However, it is subject to federal income tax. So while the yield might not be as high as other investments, the tax advantages can make T-bills a worthwhile addition to your portfolio. So as you can see, investing in T-bills involves a unique process. Like any investment, T-bills come with their own set of benefits and risks. Let's start with the benefits. Treasury bills are widely recognized as one of the safest investments around. Why? They are backed by the full faith and credit of the US government. In other words, unless the government defaults on its debt, your investment is safe. Another benefit of T-bills is their high liquidity. You can buy or sell them easily because they are in high demand. If you need to convert your investment into cash quickly, T-bills are a reliable choice. They are sold in a variety of maturity dates from a few days to a maximum of 52 weeks, offering flexibility to investors based on their needs. Perhaps one of the most appealing benefits of T-bills is their tax advantages. The interest earned from T-bills is exempt from state and local taxes. This can be a significant advantage for investors in high-tax states. Now, let's turn our attention to the risks. It's important to note that while T-bills are generally considered safe, no investment is without risk. One risk is inflation. If the inflation rate rises above the interest rate of the T-bill, the purchasing power of your investment could decrease. This means that the money you get back from your investment might buy less than what you could have bought when you first made the investment. Another risk is interest rate risk. If interest rates rise after you've purchased your T-bill, you'll be stuck with a lower return than you could have earned if you had waited to invest. Lastly, while it's highly unlikely, there's also the risk of default. If the US government were to default on its debt, it could potentially impact the return on your investment. But remember, while T-bills are generally considered safe, no investment is without risk. Let's quickly recap what we've learned about T-bills. Treasury bills, or T-bills as they're commonly known, are short-term securities issued by the US government. They're essentially IOUs, a promise that Uncle Sam will pay you back at a later date. These are a safe and secure investment option, backed by the full faith and credit of the US government. We've talked about the importance of T-bills in the grand scheme of things. They play a key role in the financial market, helping the government raise funds for its various operations and projects. They're also an essential tool for managing the country's money supply and influencing interest rates. In terms of how they work, T-bills are unique in that they're sold at a discount and mature at face value. This means you buy them for less than their face value, and when they mature, you'll receive the full face value. The difference between the purchase price and the face value is your interest, which is why T-bills are referred to as a zero-coupon security. Then we delved into the benefits and risks of T-bills. On the plus side, they're considered a low-risk investment due to their government backing. They're also highly liquid, meaning they can be easily bought or sold. The downside? The returns on T-bills tend to be lower compared to other investments. And while they're considered safe, they're not entirely risk-free. They're still subject to inflation risk, meaning the returns may not keep up with the rising cost of living. In conclusion, T-bills are a potentially valuable addition to your investment portfolio, particularly if you're looking for a low-risk, short-term investment. But, as with any investment, it's important to understand what you're getting into. Remember, understanding the different investment options available can help you make informed decisions about your financial future. Thanks for watching.